Hello, welcome to my class in macroeconomics on the role of banks in the economy. My name is Andreas Nabor from the Isle of Man International Business School. The following 4 slides will introduce you to the role of banks in the economy and their importance in our lives. From the circular flow of income model, we know already that banks play a crucial role in transforming savings into investments. However, their role in the economy is much greater than that. Payment for domestic consumption is very often channeled through banks, and also exports and government expenditure require a functioning financial system. Banks and other financial institutions are known as financial intermediaries. They all provide a crucial link between those who wish to lend and those who wish to borrow. Financial intermediaries take in deposits and have specialist knowledge to be able to channel funds to those areas that yield the highest return, and this again attracts deposits. And based on their specialist knowledge, they can give advice to their customers on financial matters, on the best way of investing their funds, and on alternative ways of obtaining finance. Whilst channeling funds from savers to borrowers, banks perform a so-called maturity transformation. Whilst you want instant access to your money at all times, banks are willing and able to lend on this money long term. Thereby, they also transform risk. Whilst you may be aware of a number of risks and have learned to manage them, financial risk may be not one of them. You might not be willing to lend money directly to another person or company because you don't know them well and they might default. Banks know their clients and have the capacity to assess the risk and to absorb the loss if required. So banks are willing to guarantee you paying back your money whilst lending it to someone else. And finally, we frequently use the banking system to transmit payments for consumption, utility bills, and even the odd parking ticket. With these 5 functions, banks perform a crucial role to the society. With maturity transformation and risk transformation, banks are also taking on a considerable risk. And indeed, this is their job. Therefore, those few commentators demanding banks to take no risk at all are clearly misguided. Assessing, taking on, and managing risk is the most important role of the financial system. What is more, the bigger a bank is, the greater are its economies of scale and the better it can perform all these functions. That is why governments have allowed banks to grow bigger and bigger. Unfortunately, the recent financial crisis has shown that the huge size of banks can also be a risk in itself. If a big bank collapses, this will have a devastating effect on the economy. However, the bank may be so big that even the government cannot save it. The 5 functions of financial intermediaries are also reflected in the balance sheets of the banks. Banks take short-term sight deposits and longer-term time deposits, mainly from the private sector. These are shown as liabilities on their balance sheets because your bank owes you the money that you have put in your account. On the asset side, the majority is made up by rather short-term market loans, by investments, and longer-term loans, also known as advances. It is the bank's business to bridge this maturity gap, and that is what we pay them for. At the same time, banks need to be careful to keep enough liquidity to be able to pay out customers on demand. Next class we will discuss how banks manage that, and how this function failed during the recent financial crisis.